Okay, we're going to just a quick economic overview. Things that I'm looking at here from a U.S.-centric point of view. Of course, the global scene is just as important, but one of the things that we're looking at to move the markets in the next 10 to 12 months is obviously interest rates and, of course, the shape of the yield curve. If anyone's been watching, and most people that trade futures or trade the financial markets, it's one of the more important things to watch. And the shape of the yield curve is changing dramatically. It's about ready to go parity, short-term to long-term. The difference between 10-year notes and 2-year notes is down to around 35 to 50 basis points. It was well over 100 basis points a year or two ago. So if that should invert, it's usually a sign of a few problems ahead in terms of economics and economic growth. But not always, but be careful. We have to watch that. And interest rates certainly have an influence on the cost of equity, the cost of all commodities, and they're worth watching. Not only that, there's ways to play these interest rate moves too, but here we're talking about crude oil and the metals, and particularly gold. Oil prices, of course, very important since the world is based on energy prices, and it's about 1/2 to 2/3 of the usage in terms of gross domestic product. A lot of money goes into the energy markets, and it's very worth watching oil prices because they have an influence on everything because a lot of products, not only gasoline and refined products and gas and oil, are derived from the price of oil, but a lot of plastics, a lot of synthetic materials are from oil. So oil prices affect everything from synthetic materials all the way to the price of gasoline in our automobiles. The global debt situation has been around for quite some time now, but it's something that's concerned some people. There are some countries with a little excessive debt relative to their GDP, and then some seems to be in better shape than others. But the more debt you have, especially at these low interest rates around the world, when interest rates start to go back up, as they have, it just makes the cost of that debt even more. And in the United States, if the cost of debt goes up appreciably, and the United States will be paying a lot of money in interest, and that takes away from doing other things like building roads and infrastructure, military, and things like that. So the global debt situation, not just the United States, but on countries in Europe and certain countries in Asia too, is very, very important. And how that's dealt with in the next few years will certainly have a macro effect on the financial markets, including oil and including metals. Credit issues, the spreads between low credited bonds, or junk bonds as we say, versus treasuries is pretty low. Usually junk debt is 200, 300, 400 basis points more than treasuries. It's more on the low end of that. In a crisis, it can get out to 1,000 or 1,500 basis points above treasuries. The other thing that we're looking at here, especially in the United States, is, and there's some other world markets that are like this too, is overbought, oversold indicators. For those of you that trade technical analysis, RSI is relative strength index, and to get an RSI of 90 on a 10-year monthly chart is very, very rare. It represents a market that's been going straight up with very little in terms of correction. So we're going to watch that too, and that will certainly have an effect, because big markets and big moves in the S&P 500 and the stock market also can influence the oil markets and the metal markets too. When there's large downward moves, we tend to see moves upward in gold, and we tend to see downward moves in oil prices, depending. But they can track independently of each other. They don't necessarily all go down or all go up at the same time. Okay, so just a quick little summary here of what's been going on in North America in the last few years up until now. It's been nothing short of a renaissance in the United States. U.S. crude production, it's had a huge impact on the global market, and part of it is technology and infrastructure driven. OPEC's focused on U.S. oil production. Believe it or not, for one of the first times in history that I can remember, they've asked U.S. producers to cooperate in OPEC cuts, which is very, very rare. Usually OPEC is the swing state, so to speak, and they have a large influence on oil, obviously, because they're very large in terms of producing. We've had a dramatic increase in production because of technology and hydraulic fracking here in the United States, particularly in 2 or 3 regions in the United States, around Texas and around Pennsylvania. And our production's up 75% from 2010, and it's up to 9.49 million barrels. And that's as of September 2017, and we're expected to hit 12 million barrels per day by 2025, and that would surpass Saudi Arabia's current production, the largest producer in the world, aside from Russia, who produces a lot of oil and gas too. Infrastructure developments also are having a big influence on crude oil prices, and the reason why we're down from $120, $130 a barrel all the way to where we're around 60, 65 now. We were down as low as the high 20s, low 30s. But we have market pipelines. We have a Trans-Canada and Seaway market pipelines. They provide a lot of oil from various parts of North America into the Houston area. We have a Dakota Access pipeline that's got almost a 500,000 barrel capacity that ships oil from North Dakota to Houston. So oil flowing to and from Canada has had a big impact on the price of oil. We also have something that's just become legal in the last year or so, and it's exporting of U.S. oil. It was illegal to do so, and that's completely reshaping the crude oil market. We have light sweet crude oil exports, and they compete directly with Brent and other grades of crude oil too. We have exports to China and the rest of Asia Pacific, and it makes WTI a key benchmark for Asian markets now, along with Brent. They've been fighting it out for number 1 and number 2 place to be the benchmark, Brent and WTI. They're both very key benchmarks. But some interesting things have happened in the U.S. market, and it certainly has inflected the WTI market. So crude oil exports have hit a record 2 million barrels per day the week of September 27th. We look for that to continue. And combined U.S. crude and petroleum product exports hit 5.6 million barrels per day in 2017. So, in summary, WTI, it's reclaimed its status as one of the leading indicators for price discovery, and it's a very liquid market here at the New York Mercantile Exchange, which is a part of the CME Group. We see a chart here on this next slide that shows crude oil exports and where they go to, the various Canada, China, the rest of the world, the United Kingdom, Singapore, Italy, and the Netherlands. And you can see prior to 2016, there was nothing. It was basically parts of the world, and that's it. It was mostly, a couple of nations. But now it's going all over. It's going to China. It's going to all the Asia Pacific region, all over Europe, the Netherlands, Italy. So there's a lot of oil that we're transporting. So that's also helping reset prices on a worldwide basis. These increasing crude exports, they've certainly driven volume up dramatically. We've become a much more of a world market. It was always a worldwide market, but even now more so. And the interplay between WI and Brent more important than ever before. And we're going to talk about that in the Brent WTI spread. And we've overtaken ICE futures in terms of volume. So things are looking good in terms of activity and liquidity. And we'll talk more about that as we actually get into the futures contract. I wanted to give a little background on some of the oil economics over the last year or so, and what may be happening in the future and how it will impinge oil. All right, so crude oil, it's one of the more liquid crude oil benchmarks. It's actually one of the more liquid futures contracts in the world. Month on open interest, it's right around 2.5 million as of September, and it's not too much different than that at the end of the year. I believe crude oil was around 2.4 million contracts outstanding in terms of open interest. Volume is about 1.4 to 1.6 million contracts a day. That makes it the third most active contract at CME Group, next to the Eurodollar futures contract, the interest rate contract, and the E-mini S&P 500 futures contract. We broke a record for open interest back in the fourth quarter of last year. We hit over 2.5 million contracts. So again, it's looking up. If you see the chart there in the upper right-hand part of the thing, you can see upper right-hand part of the chart, the slide. You can see open interest going dramatically higher, and you can see volume going dramatically higher too. So everything we've talked about in terms of the technological advances in crude oil and the prices of oil and all the exports of oil, you can see it reflected in volume. And that offers opportunities for traders. One of the great things, especially given that we're doing a seminar here for clients in Singapore, is that volume, our non-U.S. trading hours, outside U.S. trading hours, has gone up dramatically. The volume's gone up dramatically over the last 12 months versus the prior year, and the liquidity in terms of the bid-offer spread across the first 3 futures contracts also gone up dramatically. And this is important for anyone in Asia or in Europe that wants to trade our products. If you have great liquidity in the U.S. time zone, it doesn't do much good for Asian traders or Asia Pacific traders if they can't get liquidity in their time zone. So we're fortunate that we're seeing great liquidity across all time zones outside the United States. Okay, so on the next slide here, we just to give a summary of the last 2 decades of price action for crude oil. You see the run up from basically the beginning of the century, around 2000, all the way up to $150 a barrel. Then the financial crisis came, and the price of oil dropped dramatically to about $26, $27 a barrel. Then we again had a nice rally over the next few years as the world financial markets recovered from the financial crisis, and we went back up to about $115 a barrel, something like that. And then in 2014, 2015, we see the beginnings of the tremendous bear market in crude oil, and we dropped from basically around $100 a barrel all the way to about $26 a barrel, and we stand at double that now. We're actually about $62, $63, $64 a barrel. So tremendous price action, tremendous volatility for traders out there. Crude oil not only gives you tremendous liquidity in various time zones, but it gives you movement too. There's been really, really good movement. Even though volatility has slowed in the last couple of months, overall there's good volatility in the crude markets. I think volatility is running around 23 to 25% now. It gets up as high as 50, 60%, and that allows traders the potential to do a lot of different strategies, whether you're a hedger, whether you're a trader, whether you're a spread trader. There's a lot of opportunities out there. More of a short-term chart on this nice short-term price chart on this next slide. It just shows what's been going on just for the past year, basically. And it shows the nice move steadily going higher up into upper 50s. And now, of course, couldn't update the chart, but we're in the low 60s now, low to mid 60s. So crude oil continues to do well. Depending on how the world economy goes, and it looks like the world economy is in much better shape than it's been in a long time, we look for stronger crude oil prices going forward. Barring a recession, barring some disruption in supply and demand equation, prices should remain pretty decent over the next couple of months or next couple of quarters. They should be firm. All right, now this slide here is it's a review for those that don't know too much about futures, but it'll be a good review for those of us that have traded futures and do know futures. But and I'll go over them very, very quickly. But the top reasons, the compelling reasons why you should consider trading WTI, as well as metals, which we're going to get onto later in this webinar. One, cheap execution costs. When you compare execution costs with futures versus other types of investments, they rank pretty low, and in some cases they rank the lowest. So you can take my word for it. You can look at liquidity flows, and if you look at the ETF market or the swap market versus the futures market, you can see money flows into the futures markets quite readily. It's very, very liquid, and one of the reasons why is it's cheap execution costs. People that trade, if they're trading actively throughout the day, every day, they want to keep their execution costs low, and energy futures and many futures contracts are a way to do that. Liquidity is unparalleled in the energy complex. Crude oil, again, is the 3rd most liquid futures contract we have at CME Group. It's also one of the most liquid in the world at 1.4 to 1.6 million contracts a day. There are very few futures contracts that do 1 million a day. There are very few futures contracts that do 500,000 contracts a day. So you have great liquidity in WTI crude. You have capital efficiencies too. If you wanted to buy $63,000 worth of crude oil, which is what the contract is worth, it's 1,000 barrels, our WTI contract. We'll get into the contract specs a little bit later. We'll review them. But you don't have to put up 50% margin like you do in the U.S. stock market. The leverage is reasonable. It's about $4,000 to $5,000 you have to put up for margin. So it's roughly 6%, 5, 6, 7%. You also have virtually 24/7 trading. I'd say 23/5. We're not open on Saturdays. We open on Sunday in the afternoons. So we have continuous trading. You can trade overnight. You can trade outside the Asian time zones. You can trade in the European time zones. And there's pretty good liquidity, as we're going to see in a couple slides later on. Strategic reasons, there's things you can do in the futures markets that can't be done in other markets, such as spreads. If you wanted to spread, WTI versus oil or Brent versus WTI, very easy to do in the futures markets. Plus, you get margin offsets. And again, we'll talk about more about that later when we talk about strategies, in particular spread strategies. Trading WTI it's a pure direct play on the markets and various asset classes. If you want to trade crude oil, people do it with energy stocks sometimes. Here in the United States, we get inquiries all the time. How do I play the up and down markets in crude oil? And some people want to do it via the integrated energy companies like ExxonMobil or Chevron or, PetroChina. And crude oil is just a more direct play. If crude oil goes up and down, you'll participate. We'll talk more about this later, but ExxonMobil, Schlumberger, all the oil drillers, the oil companies, the integrated oil companies, they don't always move directly with crude oil. So you want a direct play, and if you're going to play crude oil and it goes up or down a dollar a barrel, you'll make or profit by $1 a barrel, or lose $1 a barrel, depending on what your position was. That necessarily wouldn't be true with energy stocks. They may not go up if oil goes up $1 a barrel. They may not go down if oil goes down a barrel, because they have upstream operations, downstream operations, they have chemical and refining operations, and on a day-to-day basis, those aren't so much influenced by the price of crude oil. All right. Supply and demand, smoke and mirrors absent. Sometimes around the world, and including the United States here, there have been some accounting irregularities with various companies. If you study the Enron situation, it's a great case study in how certain accounting irregularities caused the downfall of the company. With crude oil, it's a gigantic market. It's very hard for anyone to manipulate. It's impossible practically. OPEC used to have an influence, but they don't have that influence anymore. But it's a multi-trillion-dollar market, along with like the S&P, which is a $26 trillion market. And it's pure supply and demand. So if you're good in fundamentals and technical analysis of the energy markets, you won't have to worry about accounting irregularities because it is a commodity. It's not a company. We also have the CME clearinghouse. And that provides certain financial safeguards. Phillip Futures is one of our clearing members, I believe. And clearinghouse is the ones that impart risk management. There's an old saying that if you're not good at risk management, the futures markets will impart good risk management to you, and they will do that through the clearinghouse and the financial safeguards, which include the FCMs, our brokerage firms, such as Phillip. So they will make sure that the system has integrity, and they will make sure that enough performance bond margin is put up, and they have certain discretion in terms of how much that is, as long as it meets the Merck clearinghouse margins. Ninth reason, successful traders trade futures. Most successful traders trade futures, as do big players such as pension funds, some of the great hedge funds, some of the great investors over time trade futures contracts. So it behooves people to learn to do this, to learn futures. And they're really, if you never trade them, even if you were to never trade them, they're wonderful indicators. They're very sensitive. They'll move rapidly. They're very sensitive in terms of being the first responder. Futures will respond to world events much, much quicker than some of the other markets because there's a lot of very, very large and liquid players that trade in this market. So that leads to number 10. Futures are very sensitive, and they're the first responder. There's also tax advantages, but that's for citizens here in the United States, so we will skip that. All right, so real quickly, we'll go over the contract specs. Hopefully, folks that are tuned into this seminar, they have some knowledge of futures contracts. Each futures contract has its own contract specifications or contract highlights. For WTI, the size of the contract is 1,000 barrels of oil. So the notional value at the time I made this slide, it was about $57 a barrel, with $57,000. Crude oil is back up to around $62, $63 a barrel. So now the contract notional value is $63,000. So it's just 1,000 barrels times the price of oil. It's very simple math. The minimum fluctuation, or the minimum tick size, is 0.01. So each tick that it moves, or each penny, so to speak, represents $10. So the dollar value of one tick is $10. The minimum tick is 0.01 points, or that's really 1 cent. The ticker symbol is CL for crude oil. The trading hours, well, those are the trading hours, Chicago time. You can convert that to Singapore time, and the contract months, all months. We trade all months. I think we go out about at least 2 years, probably way out to 5 years, and in some cases 10 years, depending whether you're looking at futures or options. Current open interest as of December is 2,495,000 contracts. Average daily volume, as we've mentioned a couple times, is 1.4 million. The price limits, they're tiered. They start at 500, which is $5 a barrel, and then $10 a barrel, then $15 a barrel, then $20 a barrel. Delivery of this contract is physically delivered. So if you want to take delivery of it, you better find a terminal somewhere because you're going to get 1,000 barrels per contract. But the only people that take physical delivery are the commercials. Traders never take delivery. They usually offset their contracts before expiration or roll them forward into a different expiration. If you go to CMEGroup.com, our website, you can look at price quotations for WTI crude, and these are based on November 22nd. They're a little bit higher now because crude oil's rallied another $4 a barrel. But you can see the January 2018 contract would actually is expired by now. The February is going to be expiring soon. But anyways, it gives you the last price. It gives you the change, the net change relative to the prior day. It gives you the prior settlement, it gives you the open, the high, the low, and it gives you the volume traded. It also gives you the limits. So you can see there, that's $5 up and $5 down. So at that point, you can't trade any higher than that, and then the next tier would come into action. Before you trade any contract, especially WTI crude, you should familiarize yourself with the contract specs. You should know how the quotes work. Do some simulated trading. We have a simulated trading feature on our website, and it allows people to do simulated tradings for those that want a little bit more practice before they do real trading. And it's something to look into. But our website has a lot of information, and we advise people to go there to check things out or talk with your representative at Phillips. They can also give you a tremendous amount of information, and they're local. Last day trading calendar. This next chart just shows, and you can get this off our website. It shows when the contract month starts trading. So the December 2017 contract started way back in 2008. It expired in November 2017, and its settlement is the 20th of November 2017. So you can see all the different oil contracts that are available, all the different expirations, and again, it allows different spreads, different delivery months. For hedgers, it allows a lot of flexibility, and for speculators, it allows a lot of flexibility in terms of doing various strategies. Okay, so taking advantage of energy futures versus equities. This is kind of like centric, U.S. centric in terms of the U.S. stock market. So we're going to get into it, but I'm not going to get into it as much as I normally do, but we're just going to go over the part with the ETF. But a trader contacted me recently, and he wanted to know the best way to take advantage of declining oil prices. So I put up a case study, and I looked at the major bear market that we had in crude oil that started in 2015, where it lost half of its value, more than half its value. And he wanted to know, should he do it via the stock market? Should he sell short ExxonMobil? Should he sell short PetroChina, Schlumberger, all the energy stocks? Should he do the XLE ETF, the Select Sector Energy ETF that trades around the world, mostly in the United States? So how would you have answered this, gentlemen? Here's how I answered them. I finally made this case study, and I put it up. We're not going to go over this whole thing, and we're going to go over it fast because I want to get to some of the crude strategies and then on to metals. So let's just say, what was the optimal way to play the bear market in crude? We went basically from $115 a barrel to $29 a barrel. So the notional amount of crude at the time of the high of the contract was $115,000. So I used that as the common denominator for the stocks in question that the gentleman had asked about. But we're only going to concentrate on the Select Energy Sector ETF because most people around the world are very familiar with the ETF market and trade ETFs. ExxonMobil, Schlumberger are traded worldwide too, mostly in the United States and Europe, but I believe they're traded in Asia pretty actively too. I compare all the different things, attributes here. Upfront margin required, the price decline from the high to the low, price decline in percent, the profit on the trade, and some other attributes too that make futures a little bit more of a compelling argument in terms of trading. Why does this keep changing? So if you look at crude oil, $115,000 per contract. The upfront margin's $4,500. The price decline was from $115 to $29. That's a 74.7% price decline in percent. The profit on the trade, if you held the trade, now obviously no one's going to sell short at the top and cover at the very bottom. Very few people are, gifted enough to do that. But in this case, he would have made $86,000. ExxonMobil from high to low went from 104 to 70. If you bought 100 or sold short 115,000 shares, its decline was 35.6%. You made 37,570. Schlumberger went from 118 to 60, down about 51%. The profit on the trade was 56,900. And the select energy sector ETF, 115,000 shares sold short. You'd have to also put up 50% of the amount. The upfront margin with WTI is less than a tenth of the amount you'd put up in the ETF or the stock market here in the United States. The profit on the trade for the select sector ETF was 57,500. So you can see, again, the best way to play crude oil is to play it directly and do it via the futures. You would have made the most money. You would have had around-the-clock trading, and you would have the ability to do spreads and get all sorts of margin offsets if you did so. The only negative is that crude oil futures don't pay dividends, but it's reflected in the price of WTI that doesn't pay dividends, so it's okay. ExxonMobil, Schlumberger, and the Select Energy ETF do pay dividends. So crude oil futures, they're a direct play on oil. All the other alternatives are indirect and don't allow as much profit opportunity and have a couple of disadvantages in terms of trading flexibility. All right, as we mentioned earlier, it doesn't help the Asia Pacific region if liquidity is not good, but there's some really good volume in crude oil. You can read on down the chart. About 10 to 15% of our volume, actually right around 14% of our volume in crude, light sweet crude, which is WTI, is done during Asian hours. So again, and that's growing dramatically, 2017 over April of 2016. Also, the bid-offer spread measured in ticks, the minimum price fluctuation ticks. The bid-offer spread, this is amongst many of our major products, but again, trading in CME crude oil in Asia, it's done pretty well. The bid-offer spreads across the Asian time zones are good. It's basically one-tick market, which is what it is in the United States. Is it as deep? Probably not, but we'll get to that in another slide later on, I believe, if we have time. Here we go, 5-level deep volume. So you take the best bid and the best offer, and then the next bid below that, the next bid below that, and you get what's called the depth of order book. You see the 5 best bids and the 5 best orders. 5 deep volume in WTI in Asian hours is 400 contracts. That is pretty darn good. That makes for a very, very liquid market. The RTH regular trading hours, which is U.S. time zone 5 deep, is about 700. So yes, there's a drop off in Asian time zone, but 400 is still make it a very, very liquid contract. Most people don't trade anywhere near 400 contracts at a clip. It's usually only large integrated oil companies or a large hedge fund or a large pension fund that would do that kind of size. But it can handle most of the liquidity needs of most traders. We're going to skip slide 19. I just wanted to do a comparison, too, before we get into strategies here. But the ETF market is very, very popular around the world. But the ETF market is just nowhere near as large as the futures market. And that's why traders prefer to trade futures, because the money flows mostly into futures. They're very liquid. I'm not knocking the ETF market. They're very exciting markets, very good for certain types of trades. But if you look at some of the attributes here, we have crude oil versus the energy sector ETF, the XLE, which we examined in a prior example. The U.S. oil ETF, there's 4 or 5 major energy ETFs. But I just want to call your attention down to the 5th row. The dollar value, the 6th row, average daily dollar volume. Okay, and average daily dollar volume, so it's the 7th row, my apologies. The average daily dollar volume of crude oil futures is $79 billion. If you add up all the other ETFs, it doesn't even come up to $500 million. So you can see there's tremendous liquidity into the futures, and this is why people trade it. It's very liquid. It's available all throughout the night. There's good bid-offer spreads. There's good depth of market, and there's great opportunities, and there's capital efficiencies. And these things are what causes money to flow into futures contracts simply because they're liquid. Okay? So you have all the attributes down there. Forget tax treatment. That's mostly to U.S. citizens, but 24-hour trading you do have in crude oil futures, and you don't in stocks or in mutual funds here in the United States. Annual expense ratio, also the futures don't have annual expense ratios. ETFs do. All right, they're very good products, ETFs, but futures get the dominating flow of funds. So to summarize, crude oil futures alone have a daily turnover far greater than the 5 major energy ETFs combined. Okay, so how do we profit from WTI? Going long, going short. We have a quick example, an illustration here. Small CTA, a commodity trading advisor. Those are available all over the world. There's commodity trading advisors all over the Asia Pacific region, European region, and also North America. Commodity trading advisors, they're like mutual fund managers. They trade a diversified portfolio of commodity futures contracts. Instead of buying a portfolio of bonds or a portfolio of stocks, they buy futures contracts. So the initial price on November 21st, when we started this example, CTA buys 5 CLF. That's the ticker symbol for crude oil. CL is crude oil. F is January. That's the ticker symbol code for January. 18 is 2018. So that's the crude oil January 2018 expiration. So the trader, the CTA, buys 5 of them. The price is $56.83. Initial margin is $2,250 per contract. Times 5 contracts, so your margin would be $11,250. That's to control. Let's see, 5 contracts. It's about $60,000 or $56,000 per contract in this example. So that's about a $200,000, $250,000 notional amount of crude oil, and you put down $11,250. Okay, next day, November 22nd, CLF 18, January 2018. Typographical error there. That's January 2018 WTI futures are trading at $57.95. So you paid $56.83. They're currently trading at $57.95. The profit at this point was $1.12 a barrel. So the total profit and loss, now we have to take the $1.12 per barrel and convert it to per contract. So $1.12 per barrel times 1,000 barrels per contract is $1,120 per contract, but you did 5 contracts, so that's 1,120 times 5. That's $5,600 profit. Okay, so the next day, November 30th, or the next day of this example, again, January 2018 WTI futures are trading at $57.40. So you initially bought them at $56.83. They're now trading at $57.40. Total P&L, it's $57 per barrel times 1,000 barrels. You do the math there, so on and so forth as the slide shows. And you've made $2,850 total profit at this point in the trade. So you can see the math is pretty easy for those that want to trade WTI. It's a simple contract, very simple math, very liquid, very easy to trade. When new traders come into the market, they always ask, what should I concentrate on? What should I focus on? We can't make any specific recommendations, but you want to stick with the most liquid contracts, the easiest ones to understand, and crude oil is certainly simple and easy in terms of its math and its contract specifications. We're going to do a real quick spread example here and then move on to metals. But as I told you at the beginning of the seminar, when I do education, I love to talk about spreads. Not because I think they're good. I used to trade them myself when I traded on the trading floor. Spreads are a very interesting way to alter your risk-reward ratio in a little bit more favorable terms. But it's also a way to get your finger on the pulse of 2 markets, and therefore it makes you a little bit more attuned to what's going on in the economy. So if you were to trade WTI crude oil, that would be good. You would probably have some understanding of the underlying fundamental market. But what if you traded WTI Brent? Is there any opportunity there? And has there been an opportunity in the past? Emphatically, yes, there has been great opportunity in trading this spread. And it also, again, gets you a little bit more in tune with the world oil markets. WTI is one benchmark, but Brent is a very important benchmark too, especially in Europe and the Asia Pacific time zone and economies. All right, so WTI and Brent generally move in the same direction, but occasionally they don't track. They move in separate directions depending on supply and demand fluctuations. When WTI and Brent diverge too much, there's opportunities that arise that the spread trader can take advantage of. A few years back, Brent traded, those of you that are logged into this seminar, those of you that have followed WTI or followed Brent traded a huge premium to WTI, and we'll show that in the chart in the next slide or two. As a professional trader or as an active trader, what might your thinking be? So when we look at these charts, I want you to think, What would you do? What's the opportunity? All right. So we also, when we're looking at spreads, we have to look at the recognized spread ratio for the trade, because it's not always a one-to-one relationship. And in this one, fortunately, it is. What's the margin offset for this trade? When you're trading both contracts at the MERC, at the CME Group, you're trading two contracts that move very close to each other, but occasionally get out of whack. Therefore, the margin offset is good. It's a very, very good discount. So the trade, the spread will cost you very little. You won't have to put up full margin on both sides of the trade. You'll get a margin discount or margin offset. So let's go over the trade. Pros and cons real quickly. You get margin offsets. It reduces risks. It reduces rewards too. You have a little bit less of a profit potential on a spread, but you have less risk as well. And there are some people that like to play the futures markets and somehow mitigate the risk. Spreads allow you to do that. So it provides additional trading opportunities that you can't do via being long or short. It's a little bit easier to take advantage of a price discrepancy between two markets than it is to try to predict outright price movement. Futures and options professionals frequently trade spreads, and trading them, as I said, helps you keep a pulse on the markets as a whole. The ease of shorting futures makes strategy very easy to implement. When you need to buy something and sell something, you can sell short with great ease here in our markets. All right, cons, it requires two legs, thus added transaction costs. Trust me, from a standpoint of a professional trader, which I used to be, to all the people I know that are successful in trading over the long run, they always have spread trades as part of their arsenal or their toolkit. While the risks are generally, but not always, reduced, returns are as well. Be careful. We're not saying that spreads are risk-free. They're not. They have risks too. It's just a little bit different risk-reward continuum. All right, so over the last 7 to 10 years has been a tremendous improvement in the extraction of oil out of the United States and North America. As a result, hydraulic fracking has allowed us to increase our production dramatically to where we're predicted to become a larger producer than Saudi Arabia in 5 to 10 years. So because of hydraulic fracking, we've had all this big glut of oil, and all this oil coming from Canada and north of the United States coming down towards the United States, combined with economic slowdowns over the last few years, although the economy's definitely been picking up in the last year. We have this glut of oil, and it's a glut of WTI crude oil. So if there's a glut of that, it's going to tend to depress the price, whereas that price pressure, downward price pressure, does not affect the Brent market. So therefore, they reacted dramatically differently. All right. So you can see here's a long-term chart of Brent versus WTI. And you can see for most of 1996 through 2010, for the most part, they traded very close to each other. In fact, Brent traded at a slight discount to WTI for a long time. But then look what happened in 2010, 11, and 12. Brent started to skyrocket, and it traded at a nearly $30 premium to WTI because of this glut in WTI. More shorter-term chart here. So you can see that spread has now finally come down because we're exporting oil and we're getting a lot more infrastructure, getting oil out of the Cushing terminal area in Houston where all that glut was accumulating. And now it's going to worldwide markets, and it's brought the spread down dramatically to almost parity. It's running roughly between $2 and $5 a barrel Brent over WTI. There's just a Bloomberg print screen there that shows the more green, the wider the spread. The wider the band gets, the wider the spread. So again, there's lots of different chart packages out there that you can get, and lots of information that show spread relationships. So the spread, real quickly to review, the margin, the clearinghouse recognizes a 1-to-1 ratio of WTI to Brent. Okay. So you would just, if you thought that WTI was going to rally relative to Brent, you would, go long one WTI and short one Brent. Okay. If you thought the opposite was going to happen, Brent was going to outperform and that large premium was going to assert itself again, you would get long Brent and short WTI. Since they track each other very, very closely and they have very similar volatilities, although Brent's a little bit more volatile, the margins are nearly the same. For WTI, it's 2250. For Brent, it's 2300. Combined margin is 4550, but you get a margin credit of 83%. So 4550 times an 83% discount, you'd only have to put up $773 to trade this spread. So again, before we move on to metals, I just wanted to point out that trading spreads offers a lot of advantages. And again, it puts you more in tune with the crude oil market. And I think it's going to be one of the more exciting markets. I think many of the players out there in the market feel that the energy markets have always been pretty exciting. So I don't look for that to stop anytime soon. All right, so we're going to skip on ahead here because I want to make sure we cover the metals here, and we have about 20 more minutes left. We're going to get on to metals. So we're going to talk mostly about gold, but we're going to talk about a common spread that's done here called the platinum gold spread. Again, top 10 reasons why you should consider trading metal futures are the exact same reasons why you should consider trading WTI futures. Cheap execution, liquidity, unparalleled capital efficiencies, 24-hour trading, strategic reasons, pure direct play on the markets. Again, you can play gold mining stocks or silver mining stocks or any kind of mining stock, but the direct play is usually done in the metals futures markets. Supply and demand, it's a pure supply and demand market. You got the clearinghouse. And again, most successful traders tend to trade futures, as do big players, pension funds, endowments, and things like that. And futures are very, very responsive. They're very, very sensitive to movements in the underlying. So keep these things in mind. All right, our leading metals futures contracts, it starts with gold. We do about 316,000 a day. Believe it or not, copper, industrial metal, is our second leading contract at 111,000 contracts per day. Silver is third with 98,000 contracts per day. Platinum about 19,700, and palladium 5,200 approximately. You can see the open interest there. Again, when you're getting futures contracts trading, six figures and open interest in the $250,000 to $1 million range, they're mega contracts. They're very liquid. There should be no problem getting in or out, even if you wanted to do a spread or you wanted to do a large number of contracts. We also have the options ADV, average daily volume, listed there, and the options open interest. But we're going to focus mostly on futures here. Okay. We'll skip that. Okay, so this has the same summary, but a different time. But it gives you the average daily volume going back many quarters, 3 years worth of quarters. Gives you gold, silver, platinum, palladium, and you can see it tracks, it looks just like the WTI chart. There's been a lot of interest in metals lately, whether it be industrial metals because of copper. Obviously, China, a very large user of copper. India, a large user of copper. The United States, large user of copper. Dramatically increased our volumes in copper. Platinum palladium dynamic has changed dramatically because of catalytic converter usage in diesel engines versus non-diesel engines. And gold is always, it's been in the spotlight in terms of precious metals. So we have a good conglomeration of precious metals, industrial metals. Platinum could be an industrial metal and a precious metal because it's used in catalytic converters. And there's a lot of activity in the market, and you see it in the chart. We'll go over some of the gold fundamentals real quickly here, and then we'll get into some strategies just like we did with WTI. Obviously, gold is jewelry, industrial demand, investment demand is about 40%. And, of course, all-important central bank purchases, and these account for under 10% of demand. So jewelry and investment demand are the biggies. If any of those fall off appreciably, you'll see a major move in gold. Industrial demand, well, it's electronics and dentistry, less than 10% of demand. So you should be aware of these fundamentals and how they will affect things, how they'll affect the metals markets. But central banks can step up their purchases at any time. They can step up sales at any time, and they sometimes create some short-term volatility in the markets. Gold supply, there's a combination of mining supply and scrap. Central banks were net suppliers of the market, but turned net buyers probably in 2009, and it's probably stayed that way, which is why gold has had a pretty decent bias since coming down from its high of $1,900 an ounce. It's produced on nearly every continent, and top countries, China, Australia, Russia, and the United States. Top scrap supply is China, India, Turkey, and Italy. So keep a little bit, be mindful of some of these supply concerns because they will affect the supply and demand equation and therefore the price. Gold price drivers, we all know these very well. Gold and the U.S. dollar negatively correlated historically. Interest rate expectations, gold and interest rates are negatively correlated. And when interest rates go higher, gold has a hard time going up because the cost to hold it and store it goes higher, okay? And not only that, it's a competition thing. And interest rates go higher, there's competition, and a higher yielding instrument makes it more competitive than any other instrument. But gold is also, they say non-yielding, and it's historically been viewed as a store of value, but be careful there. Gold, you can get yield out of gold. All you have to do is sell options on, you can do covered rights on gold futures. That's one way to do it. It's one of the arguments. People say gold doesn't yield anything, but you can get yield out of it in the options market. We have more of this on our website, and the folks at Phillip's Futures also can tell you how to deal in options in such a way that you can get some interest on your gold, or actually sort of a dividend, if you will. Geopolitics, obviously very important in the volatility of gold. It's looked at as a safe haven. It's where people go in a panic. Global market volatility, especially in currencies, has had a great effect on gold demand. When currencies have been volatile, you can see it in the price of gold. It moves dramatically. Long-term drivers, mining supply, obviously inflation, and oil prices to some extent too. They've been positively correlated. And versus currency, DXY is a currency index. You can see gold, GC1 is in black, green is a currency. When currency goes up dramatically, the currency, it's a price index of the major currencies, a basket of currencies. Gold goes down, so you have to be careful here. I'm going to skip this slide. All right, I want to just go over some quick volume trends. Gold alone has done very well. You can see since 2016, trending very much higher. Just good activity in gold. Obviously, a store of heaven. People have been worried about inflation and just geopolitical events, and there's been some good activity in gold as a result. Silver also pretty flat. It had a big rally in 2011. Then the volume kind of was flat for several years, but then it started to pick up in 2016 and 2017 dramatically. Why trade gold futures now? We offer several contracts, but we're going to focus on the 100 troy ounce contract, the big contract. We have a mini gold, and we had a kilo gold at 1.2, but most of the volume in open interest is in gold futures, the major 100 troy ounce contract. So, all right, like we do with crude oil, the contract specs for gold, which is the feature that we're going to trade here, is 100 troy ounces. We're going to talk about platinum later too, but platinum one is half the size. It's 50 troy ounces. The minimum tick with gold is 0.10, just like crude oil, which equals $10 a tick. So it trades in dime increments. And that's $10 for the value of one tick. The symbol is GC. Trading hours is pretty much the same as crude oil. We always have a 1 hour break each day at 4 o'clock for system uploads and downloads and system maintenance. The current contract months, we have the current calendar month plus the next 2 calendar months, usually within a 23-month period. So any February, April, August, and October contract. You have a June and December contract within a 72-month period. So we go out 5 or 6 years here, but we don't offer every month, obviously, like we do in crude oil. So be careful. You can go on our website, and you can see all the months that are listed, when they first get listed, and when they expire. Trading venue, it's CME Globex. It's electronic trading, nearly 24 hours a day, 6 days a week. We're not open on Saturdays. Options are available also, monthly options and weekly options. All right, so let's look at gold, and let's look at it in terms of trading gold versus platinum. We'll look at two markets again. May put you more in tune to the markets. I think it won't make you a great trader, but learning about spreads will make you a better trader. Some of the best traders I know trade spreads as part of their toolkit, as I talked to you. So over the last 10 years, gold and platinum, they tracked each other very well. But then platinum climbed to a substantial premium over gold. We'll show you a chart on this, but now gold trades at a substantial discount. Platinum trades at a substantial discount to gold. So again, as a professional spread trader or an active spread trader, what might your thinking be? What's the recognized spread ratio for this trade? Is it 1-to-1 like WTI Brent? What's the margin offset for this trade? And what's the total required margin to implement this strategy? So we look here, platinum versus gold over the long run. You could see platinum traded at almost a $1,200 premium to gold. Actually, it went slightly over $1,200 for a little bit. And then some things happened in the catalytic converter market. And it turned out that there was a major swing over to palladium. And palladium started to get top billing as a catalytic converter component. And the demand for platinum dropped off. It's still used in catalytic converters, but palladium is more useful. I think it's because diesel engines are a more popular vehicle in many parts of the world, and palladium is a better catalytic converter for certain types of engines. As a result, platinum demand dropped off dramatically relative to gold, and that spread collapsed completely and went to a discount. So we're roughly $200-300 discount now. Platinum's a $200 to $300 discount to gold. This is pretty amazing. Most spreads don't move anywhere near this amount. This is a very large move for a spread, but it's something that traders are starting to look at now. Some very large traders and large institutions that I talk to frequently are looking to see platinum reassert itself and close that discount up and trade to a premium. Maybe not get anywhere near a $1,200 an ounce premium, but at least go above what it's at now. Shouldn't be a $300 discount according to these people. So we'll see what happens. But the way to play it, if you thought platinum was going to go to a premium to gold and outperform gold, you would get long platinum and short gold. If you thought gold was going to continue to gain on platinum, you would get long gold and short platinum. So you can see here, just like we did with the other spread, will the major divergence right itself? Will platinum reassert itself as a premium over gold? So the clearinghouse requires, what's the spread ratio? The platinum contract, it's a 50-ounce contract. So you want to get as close to dollar neutral as you can. So the clearinghouse requires you to do 2 platinum futures versus 1 gold futures. Now you can do any ratio you want, but the clearinghouse for margin offset purposes will require 2 platinum versus 1 gold. So if you want the clearinghouse margin offset, you have to do it at that ratio because that's where the risk reward ratio and the margining benefit link up. So the margin on 2 platinum contracts, it's $1,750 times 2 contracts, so that's $3,500. The margin on 1 gold contract is $4,900 per contract. So to do the spread, 2 platinum to 1 gold, you'd have to put up $8,400. However, you get a spread margin credit because if you do the gold and platinum here at CME Group, you have offset because they do track each other very well, aside from when this spread went to a premium and then went to a discount. But overall, on a day-to-day basis, gold and platinum track pretty well. There are periods of time when gold outperforms, and then there are periods of time when platinum outperforms. But you do get a really good spread margin credit of 65% here. So instead of paying $8,400, you only have to pay $2,940, so you get about a 65% discount. So that's pretty good. And again, this is a Bloomberg print screen that shows the platinum gold spread, and you can see the more red you have here shows the wider the discount of platinum going to gold. So it's roughly $200-300, I believe. Again, something for traders to watch. These things move a lot, and if you wanted to trade gold outright all by itself, you can do that. You wanted to trade platinum all by itself, you can do that. Again, trading spreads is just a way, I think, to get you more attuned to the economics of the metals market and what's going on in one metal versus another, and maybe try to profit from that price discrepancy and change your risk reward a little bit. All right, with the remaining minutes we have, we'll go over a couple more things real quickly here, and then we'll take some questions. If people want to write in their dialogue box, you can write questions, and we'll take them. But we have here a chart of the gold-silver ratio. I put this up here because it's pretty pertinent now. Gold and silver, obviously gold trades at a much higher rate than silver. It's usually right around 40 to 50 times. Gold is 40 to 50 times pricier. It usually takes about 40 or 50 ounces of silver to equal 1 ounce of gold in terms of price and the dollar amount. we're trading up around 80 now. It's really, really high. Gold is trading at a very, very high premium in terms of gold-silver ratio. And there might be something there, too, for a trader, too. You don't have to do gold and platinum. You could do gold alone, gold versus platinum. You could do gold versus silver. Why has this happened? Well, very simple. Again, it always pays to look at some of the fundamentals. And if you look at the fundamentals of silver fabrication, all the uses of silver, well, we've got the advent of digital cameras over the last 5 or 10 years. So traditional photography required silver and silver halide products. So as a result, the photographic demand was very large, but that peaked in 1999 and just started its long down slope up until 2017, where the number of millions of troy ounces used by photography in silver has gone down dramatically. And it's, so jewelry and silverware is taking up some of the slack. Electronics and batteries, because everything's so technological now, and phones and iPads and computers, electronics have taken up some of the slack. Solar panels have also increased their usage of silver and other uses. The key thing here is that's it. The photography industry, the silver photography industry, can only die once. So the supply and demand is getting more back into equilibrium, and there could be an interesting trade here. If silver were to start to outperform relative to gold, could be something to look at. As we're winding down here to our last couple slides, and then we'll take questions, but I just wanted to compare ETFs, gold ETFs to futures. Again, a lot of people trade ETFs. They're very popular instruments around the world. But if you look at COMEX Gold, and again, we're going to go down 1, 2, 3, 4, 5, 6, 7 to the 7th row, average daily dollar volume. Gold futures trade around $37 billion a day, an average daily dollar volume. The Spider Gold Trust, which is the most popular of the gold ETFs, trades a little less than $1 billion or 0.88 billion, and the iShares Gold ETF trades about 0.1 billion. The two of them together trade right around $1 billion. So COMEX Gold futures trade 37 times average daily dollar volume than their ETF counterpart. So again, I can talk all day long, but the marketplace has voted, and a lot of people just prefer gold futures because they're more liquid, because of all the attributes we talked about. Leverage, 24/7 trading, liquidity, all these things are important, and traders recognize this, and that's why they outtrade the ETFs, $37 billion to $1 billion. Also, it's if you look at the primary ETFs versus the primary futures contracts, it's not even close. The average daily volume in futures is quite high relative to ETFs, and it works well. ETFs, excellent products, but at the same time, futures are even more liquid. So as we start to wrap up here, and folks can submit their questions, just want to let you know that you can go to cmegroup.com. You can get all the information on all our products. We also have the CME Institute, and you can get there via institute.cmegroup.com. There are a lot of modules, educational modules, videos that will go into more depth. If you want to learn about spread trading, we have one on spreads. We have several on WTI. We have several on metals, and there's all sorts of coursework so that you can further your education. And always do your homework when it comes to these markets because they move around a lot, okay? So I want to thank the folks at Phillip's Futures on behalf of the CME Group, and now we will poll for questions. So for those of you that have questions, we have about 5 minutes or so to answer some questions. We have a couple questions here on average daily volume in futures. We listed all those. The average daily volume in futures in gold is about 317,000 a day, and in crude oil it's about 1.4 million a day. So it's plenty of liquidity. Another question, where can I get the volume and open interest number? Those are all on our website. You can get all the open interest every day, the average daily, you can get the volume that occurs on the previous day, and the volume and open interest is all on our website. Someone had a question about the U.S. dollar trend. Not doing too well lately. We're at the CME Group. We're not allowed to make predictions necessarily on where we think the markets are going to go, but U.S. stock market's strong. Our bond market is okay. Our economic situation's improving. But if interest rates were to go up appreciably, it could rally the dollar. But right now, it seems to have not done so well over the last year. Is futures open to manipulation? Oh, I love taking questions like this. The S&P 500 is a $26 trillion market. There's no one big enough to manipulate that. The crude oil market is hundreds of billions, if not trillions of dollars. I don't think so. What's the brokerage fee? Someone asked a question. So I would ask you to contact Phillip Futures. They can give you what all the fees are and commissions on any contract. Will oil price go higher from here? Well, I'd be talking my position if I said yes, but don't know. World economy seem to be, like I said, we're not allowed to make predictions, but world economy seem to be recovering very nicely, at least if you look at the stock market. If you look at energy prices, the stocks, so Schlumberger, ExxonMobil, oil's caught a bit here. So it could conceivably go higher. Look for a correction at some point, though.